What's riskier, the wheel strategy or buy and hold? And is it even a question? I mean, the wheel strategy involves options, and options are dangerous, right? Wait, are options dangerous? Puts, calls, assignment risk, contractual obligations to buy and sell shares at specific prices. All this stuff is scary and should be avoided, right? Well, it depends. The thing is, there are a lot of different option strategies out there, and they run the gamut on level of risk. Each one has its own unique risk-reward trade-offs. And as with all types of trading and investing, it's all about risk and reward. How much are you putting at risk, and what's your potential return for that amount of risk? So, are options risky? In this video, I'm comparing the risks of the wheel option strategy to buy and hold investing. Quick overview of the wheel strategy is that it starts with selling cash secured puts on an underlying that you would like to own or that you don't mind owning. And when that put gets assigned, you own the shares. Once you own the shares, you can sell covered calls against those shares, and eventually those shares will be called away and you start the process over. Round and around it goes, and that's why it's called the wheel strategy. Now, buy and hold in comparison to the wheel is super simple. Step 1, buy. Step 2, hold. Pretty much forever. This is your standard default investing strategy. Investopedia defines buy and hold as a passive investment strategy in which an investor buys stocks and holds them for a long period regardless of fluctuations in the market. Your grandma, John Bogle, Duke of Early Retirement, and even most financial advisors would agree on the soundness of this approach. When comparing the two strategies, you might find it obvious which is riskier. Buy and hold seems to be the conservative strategy for old fuddy-duddies, those boring investors that don't know any other way. The wheel, on the other hand, seems very exciting, with decisions to make and lots of fancy terminology. Wheel is even a verb. Why simply buy an underlying when you can wheel into it instead? But when we consider some very basic math, we find something interesting. Buy and hold investing is actually riskier than the wheel strategy. That's right, in an apples-to-apples, risk-to-risk showdown, the wheel strategy emerges as the more conservative strategy. Why? Well, the reason is quite simple. While both strategies have plenty of risk, because any underlying could go down, or even way down, with the wheel strategy, you collect premium to slightly soften the impact if the price of the underlying falls. We can think of the premium collected like an airbag in a car crash. It results in less impact than if you had no airbag, but make no mistake, you can still get hurt. And thanks to that airbag, if you do get hurt, it's not quite as bad, and it should make it easier to recover. With both the wheel and buy and hold, you're holding an underlying that can go down in value. The main way to control risk is to be very careful about what that underlying is. At this point, I only run the wheel on index funds, but your risk tolerance might allow you to go balls to the walls and run the wheel on individual stocks, just as many people choose to buy and hold individual stocks. Another aspect of the wheel which lessens risk is on the cash secured put side. If you sell a cash secured put out of the money and you are assigned, you're buying the stock at a lower price than you would have if you simply bought it as soon as you thought about it. And with a lower cost basis, you simply have less to lose. To make these points real, let's look at a real-ish example. Investor A likes the buy and hold approach. Investor B likes the wheel strategy. Both investors like Apple at $150 per share. Investor A buys 100 shares at $150. Investor B sold the cash secured put 2 weeks ago at the same $150 strike price for a $2 credit, which is $200 in premium. He gets assigned, and now both investors own 100 shares of Apple. But remember that investor B is trading the wheel, so now that he's assigned shares, he turns around and sells a covered call against those shares. He sells a call expiring at the end of August with a $160 strike price for $3 in credit, which is $300 in premium. Both investors have 100 shares of Apple, but their cost basis is different. Investor A has a cost basis of $150. Investor B has collected $500 in premium, so his cost basis is $145. Time goes on and Apple's stock bounces around and heads lower, bottoming out the next month at $130. At this point in time, with Apple at $130 per share, investor A is down $2,000, while investor B is down $1,500. From a downside risk perspective, investor B is in a better position. His position is down $500 less because he collected $200 in premium for selling the cash-secured put and $300 for selling the covered call. But things don't look as rosy for investor B in August when Apple reaches $170. Remember that he sold his covered call at a $160 strike price. So no matter how high Apple goes, he's obligated to sell his shares at $160 by the expiration date. Meanwhile, investor A is excited to see Apple go so high. He'll enjoy the full appreciation of Apple stock as his profits continue to grow. With Apple at $170, investor A has an unrealized profit of $2,000. The shares he bought at $150 are now worth $170. Investor B would be in the same happy boat, but he sold the covered call at $160. His profit is $1,000 from the stock appreciation and $500 from the premium collected for a total profit of $1,500. It's still a win, but not as big a win as investor A. It's important to understand that the wheel strategy gives you premium at a cost. That cost is a capped upside, and it's capped both on the put and call side. We've just seen how it's capped on the call side, but what about on the put side? Well, let's change the scenario just a bit and have investor A buy Apple at $150 here at this point on the chart, and let's have investor B sell a cash secured put at $150 and get assigned here as well. Now, as Apple rockets higher to $170, investor A gains $2,000 and investor B gains nothing extra. He has the $200 in premium he collected, but Apple going higher and higher doesn't help him at all. Unless he's assigned, his profit is capped at the premium he received. On the other hand, if Apple were to crater down to zero, the worst possible scenario, investor A would lose his entire $15,000 investment. Investor B would lose big too, but at least he'd have that $200 of premium to dry his tears. All of this talk about risk, profit, and capping our upside leads us to the big picture, the road to building wealth. After all, isn't that what this is all about? Actually, let's get rid of the car analogy and this picture. I much prefer bikes. Ah, that's better. So then, the road to building wealth. How quickly do you want to reach your goals? Are you willing to reduce risk slightly while capping your upside and getting a lower expected return? If you're just starting out and building up your investments, this is something to seriously consider. The upside to buy and hold is not capped, and buy and hold has other advantages too. It's very hands-off, requiring minimal effort by you, the investor, well, after your initial purchase anyway, and by its long-term nature, buy and hold is very tax efficient. So if you're investing in a taxable brokerage account, this is something to think about as well. The wheel strategy might be better for those who already have a large portfolio and are looking to trade some potential gains for immediate income. But that's an idea for another video. For now, the lesson is this. Which is riskier? Well, buy and hold is actually a little riskier than the wheel, but in exchange, it has unlimited upside. And if you're bullish on an underlying, unlimited upside is a good thing. Remember, in trading and investing, as with most things in life, there are always trade-offs. All right, that's what I have for you in this video. Remember to subscribe to this channel. Thanks for watching.